You're listening to The Money Hour with your host, Tina Mitchell, on Alternative Talk 1150 AM. Now, back to the show with local mortgage expert, Tina Mitchell.
You are listening to The Money Hour on 1150 AM KKNW, the Saturday, December 18th show. You can also listen to my show podcast, my Facebook premiere. You can listen to the show on the show YouTube channel. Lots of resources for you. I am your host and local mortgage expert, Tina Mitchell. I bring into studio each week the best of the best experts in our local market on everything regarding your money. And now in studio, I have Steve Hotovec of Barastone, accessing tapped home equity without taking out additional debt right here at 1150 AM KKNW. Steve, welcome to the show.
Thanks, Tina.
Yeah, and we were talking before we actually started the show on how to pronounce your last name. How did I do?
Yeah, each time it just gets better.
Oh, good.
You're on the bullseye now. Yeah.
Yeah. Oh, so awesome. Well, so a little bit about Steve. He is president of Barastone, has over 25 years experience, or over a quarter century, in brokerage, trading, and alternative investments. He is a pioneer in the arena of non-bank, non-debt solutions for homeowners. These products provide unpredicted capabilities for homeowners to access and manage their full wealth, not just a portion of it. Barastone is focused on providing homeowners tools and resources to intelligently access and manage their largest asset. And I have to say, not only for my listeners, I know Robin's excited to hear it as well. And so am I, as a mortgage expert, and really being able to partner in helping to come up with additional resources and tapping into that home equity. So can you share a little bit about Barastone and your professional background?
Sure. My background, as you mentioned a little on the bio, is it came from a Wall Street experience, securities, alternative investments. And it also comes from looking at it from both sides of the equation. So not only what does each party get from a transaction, buyer, seller, somebody that buys a security like a equity investment or a debt investment. Are they investing for income? Are they investing for appreciation? So it's that background that actually has driven us to look at other markets. For example, if you own a lot of Amazon stock, right, which might be up where in your neck of the woods, or Microsoft, you have the ability to maybe sell off some shares. It's not an all or nothing. You also have the ability to borrow, you can take a loan against those shares. In the home world or residential real estate, the homeowner is sort of in either borrow more against it or sell the entire asset.
Yes.
And what we were very compelled of being able to bring a full capital market structure to the homeowner or the property owner that exists in the commercial markets for real estate, but doesn't do so in the residential. And I think that opens up a whole lot of capability for, the average homeowner. Right.
Definitely. Yeah. So you mentioned tapped equity. Can you explain, and how is that helping homeowners?
Well, we actually say trapped equity, but tapped and trapped.
Oh, trapped, tapped. I can't
That's okay.
read.
People, if you can't tap it, then it's definitely trapped. But what we also like to refer to it really is home wealth. Okay, because it's really the portion that you have that's true wealth. But you don't normally see it that way because you can't maybe touch it. You can't take it down to the bank. So one of the things that we say about trapped equity or trapped home wealth is that most homeowners have a concentration of their net worth in the home. And so when you look at maybe Robin or other real estate professionals, and I look at it of other investments, it is the only investment where you can say, okay, you're going to buy this investment, and if you're consuming it because it puts a roof over your head and is a comfort place, but you're going to make this payment for 30 years, or longer, or short, or whatever it might be, and it's going to, at the end of the day, comprise 60 to 70% of your net worth.
Yeah.
So what's great is it's a great forced savings plan, but when it comes time to convert from accumulating wealth
Sure.
into generating income or having the house now provide for you. That's what we mean by home wealth or trapped equity, right? It's to
Yeah.
be able to access it and manage it going forward.
Yeah. And real estate is the only asset. It works different than any other asset class because when you're getting money from it, it doesn't impact the investment growth on it. If you're taking money out of your stocks, if you take 100 grand out, now it's going to grow on $100,000 less. But if you're utilizing equity that you have in your home, it's going to still gain and appreciate on that asset based on the value of the home. So it works differently than any other asset class. So Steve, you mentioned that many homeowners, as you say, are house rich but cash poor. So, how is your company tackling this problem?
So the way we tackle it is through a product that's been around and it's been in different iterations, but I'm happy to say we were really early, like 10 years ago, got involved in this. And even now, our biggest challenge is to explain what is this thing.
Uh-huh.
And this thing or this product is called a home equity agreement. And what that means is a home equity agreement is an agreement for an investor to come in exchange for giving you cash today that's tax deferred, they will participate in some future value of the home. The more that you take out, the more that they'll get to participate. But what it allows the homeowner to do is to de-risk, de-leverage, and diversify what's usually their largest source of wealth. And these can be used short-term, long-term, all different types of use cases. But it's a very powerful tool. One quick side segment. When you look at, say, the commodities business, or if you were a farmer and you knew that the price of crops today would be allow you to put food on the table, and you could lock that in, or at least take some chips off the table. Those markets have been around forever, and that's for farmers. Well, we don't have as many farmers now, but you do have everybody wants to have a home and to be able to actually have the tools to properly take some chips off the table, but not have to always take out an additional loan where you either are unable or unwilling to do so, or sell the entire asset. So,
Yes.
um,
Okay. So let's talk about, because we're not talking about home equity lines of credit. We're talking about home equity agreements. So talk about how the home equity agreements, how homeowners are using this program.
yeah. So as you can imagine, there's a whole new use case. Well, in everything under the sun, but the top reasons are to reduce debt. So they'll use it to, just like they would maybe a HELOC. It's to put kids through college, to pay off student loans, to buy new homes. And one of the things that's very compelling that we're seeing now, it's right up your alley, is the ability. The pandemic has hit uh, the economy as Robin said, sort of the K thing, right? It's either
Yes.
really good or really bad,
Yeah.
and it has hit certain socioeconomic areas disproportionately.
Yes.
Restaurant businesses, a lot of other jobs. And so what these can do is these, as in home equity agreements, they can help homeowners become mortgage eligible. A lot of people are in forbearance. They're living off of credit cards and things which are keeping their debt to income levels high, and they're keeping their credit scores down. And
Mm-hmm.
so they can use these home equity agreements to get some money to actually pay off lower the DTI, increase the
Yep.
credit, and then consolidate and refinance. Or they could just use this agreement just to get bolster savings and cash reserves.
Yeah.
So there's a whole wide use of cases.
Okay. So can you give a couple examples of real life uh, application of the home equity agreements?
Sure. Uh, with regards to, so I like to divide it this way. The people that use these agreements are either unable or they are unwilling. So I'll give you two or three super quick examples.
Okay.
On the unable, they might be unable because they don't have their DTI is too high in their credit, but they're just right there. We do a small home equity agreement. It may be 50,000, 100,000, clean up credit, and then literally 3 months later or 6 months later, where a full credit cycle goes through, credit score can go up 100, DTI goes down by 10 points. They can get
Mm-hmm.
a prime rate mortgage. They go out of a 4 or a 3.5 or 4 or something like that it might have had because they
Sure.
couldn't get out of that cycle. That's
Yeah.
one example. The
Okay.
other that are unable to take out a loan is they just don't have the income. They can't demonstrate the ability to repay. But in these agreements, they need to have equity and demonstrate the ability to stay. So they can keep the mortgage that they have. They just they're unable to take out another line of credit because they might be retired. So that might be a case where they would have it to build cash reserves or do home improvements. And then the last are the unwilling. And the unwilling are really folks that said, I fully paid off my home. I'm happy at sharing some future value, and I'm going to take the chips off the table today. So we get that quite a bit when you're looking at people that are entering retirement or want to make a down payment for their kids. Just like Robin said, estate planning aspects of this are very powerful because you can do this while you're here,
Yeah.
buy a house for your kids using the equity that you already have without
So
signing on
Steve,
to
are
another
you
one.
seeing that people are using the home equity agreements to be able to go and buy a new home without going contingent on their current home? Or like Robin said, you really want to go buy and then you're going to sell. That's how it's going to navigate best on both sides of it. Does this work to where you have an option to help with that challenge?
Absolutely. We've used that quite a bit. As Robin said, which took the words that were not in my mouth, but I'll put them in there,
But they
which
will
are,
be in your mouth.
yeah, they are now. So you can actually buy before you sell. Okay. So you can steal second base while having your foot on the bag at first,
Yeah.
right? So you
Yeah.
have to have it. And where people are using it quite a bit is because this is not debt, it doesn't show up on your credit report because you don't have to make an interest payment. There are no monthly payments, and it doesn't show up on credit.
Huh.
So that doesn't impact your DTI. So people can actually go buy another rental home. So using your equity and by investing in a rental property, you could actually be converting equity that's trapped today into cash flow going forward
Got it.
without taking on additional debt.
Okay. So if you're listening to the show, this is a lot of information in a short period of time. So you really need to reach out to the show so I can connect you with Steve, and definitely reach out to me because I know I'll be utilizing Steve and his company to be assisting with my clients as well. So for people listening right now, and they might be thinking, isn't this like a reverse mortgage? Can you share what's different and why it's not a reverse mortgage?
Sure. I always say, well, what is this? Is what it's not. So it's not a loan, not a HELOC, not a line of credit, not a reverse mortgage. People think it sort of looks and smells like a reverse mortgage. The difference is in a reverse mortgage, that is a loan. It either accrues interest from day one. Okay. You have to be a certain age. So there are no age restrictions. You do not have to extinguish your existing mortgage. So you can have a mortgage and a line of credit. And then this could come in and even a third position in some
I was
cases.
going to say, so you're putting a third, you in that scenario, you'd be putting a third lien on the home.
It is
Yeah.
possible. And then the last thing is, if you had to move, you can rent that house out and generate cash flow. You don't have to, pay the entire mortgage off when
Yeah.
you leave the home, right? For whatever
Okay.
reason.
Okay, perfect. So, how do people decide if this is the right program for their own personal situation?
Every situation's different, and we
Of course.
have about a half a dozen programs depending on the state. So we just encourage them to schedule a Calendly call. We maybe walk through what they're looking to do and then run some scenarios so that they can compare what this option can offer versus others. And whatever
Yeah.
one makes the most sense is what they want to go with.
Yeah,
That's an option.
definitely. So if someone wants to reach out to you, how do they get to the Calendly? Did they go to your website, Steve?
They can go to our website, which is Barastone, Barastone.com. I also can be reached directly 650-315-4224.
Wonderful. And if you're driving, listening to the show, don't worry. You've got the show number 855-400-1150. Reach out and I'll get you connected with Steve. So what can people expect when they speak to one of your home wealth specialists?
So the first thing is education. We understand that this is a new asset class, so we have to break it down of what this can do, when is a good time to use it, and when there may be options that are better, such as selling the house or refinancing. So what they can expect is education and then a recommendation if it makes sense, and then a comparison as to what the pros and cons of these types of programs are.
I love comparisons. As being a mortgage professional, I'm actually a founder and owner of Mortgage Triangle software that I hired a developing team over a decade ago, which runs all of my comparisons and my team and our system and everything. But I love numbers and the ability to show comparisons from one loan program to the next. And so that's a great thing to have a takeaway in the initial meeting consultation they can have with you. So Steve, thank you so much for the information that you provided to my listeners, and thanks for being here.
Great pleasure. Thanks for inviting me, Tina.
Absolutely.